Welcome to the first in a series of webinars about the loan forgiveness process of the Paycheck Protection Program. My name is Michelle Bivens, and I'm the training director here at Farmers and Merchants Bank. Today, I will be your moderator. We know you have questions about this process. We have heard from you, and we know that you want to understand how it's going to work. And our intent is to start to answer some of those questions for you today. This is why we've partnered with Crow LLP, a best-in-class public accounting and consulting firm, and why we've asked Mr. Tim Reimink, the managing director, to join us as our presenter today. We want to be your partners through this process, which is why we are presenting this information, why we've partnered with Crow. Having said that, as in all businesses today, we have just a few disclaimers. You can see them on the slide. I am not going to read through all of those. Here is a little summary. F&M Bank is a financial institution, so therefore we do not provide any legal, tax, or accounting advice. Our educational materials and communications are not intended to replace or serve as a substitute for your close review of the guidelines. Further, you are urged to obtain any legal, tax, or accounting advice from your tax, accounting, and legal advisors. Whew, glad that's done. Now that we have the legal stuff out of the way, just a few last housekeeping items. You are in listen-only mode, and you will remain muted for the entirety of the presentation. If you've been on a Zoom meeting with a colleague that just can't find the mute button, you can understand why. So you might be asking, how can I ask questions? We have you covered. There is a question mark on the toolbar. If you click that, you are able to type in your questions at any time during the presentation, and those will come over to us. We will gather all of those questions, and we'll go through as many as we can at the end of the webinar. If we don't get to your question, don't fear. We have a website that's dedicated to this process. There's going to be a lot of information available on the website, including frequently asked questions and their answers, as well as the recording to the webinar today and the slides from the webinar today. That's enough for me to get us started. So it's my pleasure now to introduce you to Phil Bond, the Chief Credit Officer here at Farmers and Merchants Bank, for a few welcoming remarks.
Thank you, Michelle. I'm Phil Bond, the Chief Credit Officer of Farmers and Merchants Bank, where I've had the privilege of serving our clients for the last 8 years. Let me start by thanking you for trusting F&M with your business's financial needs, and thank you for being our clients. F&M has a rich history of over 113 years of being California's strongest bank for our clients, and everything we do is based on our core values of honesty, integrity, the home, the church, and service above self. A part of that integrity is to bring our clients as much education and advocacy as we can to help them achieve their business's financial goals. We hope that today's educational webinar helps you to gain confidence in both the process as well as ongoing confidence in your partners here at F&M Bank. With that, I'll hand it over to Tim, Managing Director at Crow, who will walk you through the important aspects of the forgiveness process.
Thank you, Phil. Thank you, everyone, for joining the call today. I'm looking forward to covering a variety of things about the PPP loan forgiveness process. This is the first of a series of webinars, and I want to put in a little advertisement here for next week's webinar. We're going to do an overview today. Next week, we're going to dive into more detail, cover a variety of frequently asked questions, more than we can cover today. And also, given that the SBA has just published their updated application this morning, we'll be able to provide some more specifics around completing the application form next week. So please join us next week, but let's now move on to what we are covering today. So what I'd like to do is, one, give you a little bit of a sense as what we know and what we expect about the program, but also note that there are some things we don't know at this point. And then we'll walk through all the key requirements for the forgiveness application and the forgiveness process, and include in that some hypothetical examples. Documentation is going to be an important part of your application for forgiveness, and so we'll talk a little bit about what is going to be required, what kind of documents you'll need to start assembling, and then we'll have some time at the end for Q&A. Now, of course, we also want to share with you a disclaimer similar to what you heard earlier from the bank, but we'd like to, I'm not going to read this whole thing, but I'd like to point out a couple things. We are basing this information that we're sharing on what has been provided from the SBA regarding the program. That has not been complete. There's still guidance being issued, so this is qualified. Our presentation is qualified by the fact that things may change, and we're waiting for further guidance on some questions. Also, want to encourage you to seek the advice of your own trusted advisors for legal and accounting and other considerations, including tax. This presentation is sharing information. It's not intended to be a replacement for getting advice from your own advisors as you complete your own application. And because of that, we really can't be held responsible for mistakes or losses that you may incur because of sharing information as part of this webinar. There, I've taken care of some disclaimer there. Let's move on to the things that we do know, we don't know, and also what we expect. We do know that there's going to be an application, and in that application, there's certifications from you as the borrower. There's also a Schedule A worksheet where you're going to be calculating and determining the forgiveness amount. We do know that a lot of documentation is expected to be provided by you to support the numbers that are included in your application. We know that there's guidance today that ties forgiveness amount to payroll costs and to selected other costs, and we'll talk about that in a little bit more detail later in this webinar. Now, the key concept that we know about is called the covered period. We'll talk about that as well, but really what you're looking to do is capture payroll costs and eligible non-payroll costs during a covered period, and then reporting that as part of your application for forgiveness. There are also limitations, and we'll talk about those as well, based on how many employees you have and changes in pay levels. So those are some things we know from a borrower's perspective. We know from the bank's perspective that lenders are the ones who are going to be submitting your application to the SBA. You're required to initiate the process by sending an application to the bank, and it's then the bank's responsibility to assemble a required package of information for the SBA. We do know that any loans greater than $2 million will be audited by the SBA. We expect that loans under $2 million will be subject to some targeted audits, some random audits. That's what we expect, though the SBA hasn't been specific as to what they're going to do in that regard yet. We do expect that the lenders are going to be asked to reconfirm some of the original eligibility of the loan. One of the certifications that one of the acknowledgments that you as a borrower will need to make is to acknowledge that the lender and the SBA may decline to forgive your loan if the loan was not eligible for the program in the first place. We also expect that because of that, the lender is going to be doing some reasonableness review of the request and the supporting documents in order to provide a complete package to the SBA. And one of the other things that we do expect is that not everyone truly fully understands this program and the limits on forgiveness. And that's part of the reason the bank is sponsoring this webinar and others, as well as providing a website for information, is that we are concerned that many people do not really fully understand, and therefore we need to provide more information, answer more questions. Hopefully, the SBA will provide some more clear guidance, but we don't know at this point how complete and clear the guidance will be from the SBA. We know they've learned from prior experience during the origination phase, so we expect that the guidance will evolve and improve over time. But right now, there are still unanswered questions that we'd like to have some guidance from the SBA. While you've just seen a new legislation, the Flexibility Act, caused some changes in the program, we don't know if there's going to be even more legislative changes as we move forward with this. There already is some conversation around changes, but hard to say what's going to happen with the Congress. So those are some of the things we know, we don't know, and some of the things that we expect. So let's dive into a little bit more detail around what have been the recent changes provided in the Paycheck Protection Flexibility Act. You know, one of the key changes is they've expanded the covered period to be 24 weeks, but not later than December 31st. So it's counted as 24 weeks from the date in which you received your first loan disbursement. That's a significant change, and when you see some of the hypothetical examples provided, you'll see the impact of moving from an 8-week covered period to a 24-week period. Another positive change that came with the Flexibility Act is that loans, if there is an amount of the loan that is not forgiven, that remaining unforgiven balance can be repaid over a minimum of 5 years. That's a difference from the 2-year maturity that was part of the original program. If you already have signed, and many of you have already signed a 2-year note, you can modify that note with the agreement of the lender. One other small change was to how loan payments were going to be deferred. Originally, it was 6 months deferral of no payments on the loan. They've changed this now to be that once you have received whatever forgiveness you're going to obtain, if there is any remaining balance on the loan, payments on that remaining balance would begin as soon as you receive the forgiveness amount. And again, you have up to 5 years to repay that amount. If for some reason you choose not to apply for forgiveness of any balance of your loan, and payments on the entire loan amount or whatever's left would begin at 10 months after the end of your covered period. So at latest, it would be in October of next year, since the covered periods all must end at December 31st of this year. So those are some of the key changes. Some of the impacts that we've seen on the calculation is that payroll costs are now allowed to be at least 60% of your forgiveness amount. It was 75%. That means that other costs related to rent, mortgage, interest, and utilities can be up to 40% of the forgiveness amount as opposed to 25%. And we'll go through some examples here during the webinar on how that calculation occurs. You know, the net impact that I see from all of these changes is that it's definitely more likely that many borrowers will get all of their PPP loan forgiven because of the extended covered period and because of this change from to 60-40 mix from 75-25 mix of payroll and non-payroll costs. For those that are concerned about some of the limitations that were placed in the program around maintaining FTE levels and salary levels, there are some safe harbors that were expanded as part of the Flexibility Act, and we'll talk about those a little bit more in depth later in the webinar. But as you can see on the right-hand side here, they've added a variety of additional considerations for adjusting any FTE reductions to avoid or limit the amount of reduction of forgiveness amounts because of changes in FTE. And on the payroll side, they have also expanded the time frame for returning employees to the same pay rate that they had as of February 15th. It had been they needed to be returned by June 30th. Now you have until the end of the covered period or the end of this year to return pay rates to avoid any reduction in the amount of loan forgiveness because of reduced pay rates. So again, the Flexibility Act was very favorable, has had a big impact on our calculations of what forgiveness looks like. A minor aspect of the Flexibility Act that really doesn't affect the amount of forgiveness is that they loosened up the requirements around delaying payments of payroll taxes. The original legislation didn't allow for that. All right, let's dig into the requirements in a little bit more detail here. I've already mentioned the covered period. That is a key concept. You have the ability to use the PPP funds for payroll and other eligible costs for now up to a total of 24 weeks. They also have established an alternative payroll covered period. So if you received your loan disbursement, and that's when the covered period starts, if you received it, say, on a Wednesday, but your normal payroll cycle called for payments on Friday, you can adjust your covered period to start and align with your actual payroll cycle. Makes it easier to calculate and document the payroll costs. So then when you look at the expenses that can be included during that covered period of time, the key one is payroll costs, and I'll talk a little bit more in detail on the next slide about that. The non-payroll costs are utility expenses, rent, and interest expense. One of the key dates that you see there is that for each of these non-payroll costs, they need to have been under agreements that were in existence prior to February 15th. So one of the things you'll need to document are service agreements for electricity, gas, water, transportation, fuel, phone, and internet to show that they were in existence prior to February 15th, for example. But those are the utility expenses, the categories that are included. Most of those categories are pretty self-explanatory. The one area that we'd like to have a little bit more clarity around is what would they be considered transportation expenses that would be eligible under this. And we have some information on that, and we'll talk about that a little bit later. Another key aspect of the expenses is rent. These need to be payments associated with actual lease agreements. So if the payment is called for under the lease, those are the expenses that you can include in rent. And then when it comes to interest expense, we've carved out a couple of different examples here, or categories. Interest expense on loans that are secured by real estate, mortgage loans, are covered. Interest expense on other debts that are secured by other business-related personal property would be covered. And then you have loans that were used to refinance a special SBA program called the Economic Injury Disaster Loan. One of the things to point out about interest expense is that it is not the total of your loan payments that you can include in the calculation. It's only the interest portion. So prepayments, payments of principal are not part of this calculation. So the forgiveness amounts, however, are limited, and there are two limitations that are key, and we mentioned a little bit earlier. One has to do with the proportion of the expenses that can be associated with non-payroll costs. Your forgiveness amount only 40% or up to 40% of the forgiveness amount can be associated with those other utilities, rent, and interest expense. Payroll costs could be 100% of your loan forgiveness amount if you had enough expenses in payroll to accumulate to that level. But at least 60% of the forgiveness amount needs to be associated with payroll costs. There are some safe harbor provisions, and we'll talk about those in a minute. So let's dive into payroll costs in a little bit more detail. What's included in payroll costs are cash compensation, and that covers a lot of different things. It covers typical wages, salaries, bonuses, commissions, tips. It also covers other cash payments like housing stipends. Beyond the cash compensation, medical, family leave can be covered unless they're already covered under a separate credit under Public Law 116127. Vacation time, health benefits, that would include things like medical, dental, vision, amounts paid into retirement plans, state and local payroll taxes, and any payments associated with separation or dismissal. So quite a variety of things can be included under payroll cost. One thing to point out is that these are costs that are actually paid by the business. So for example, contributions to a 401k that are made by the employee themselves, amounts withheld from their paycheck to cover payroll taxes, those are not included in the payroll cost calculation. It's only the costs that the business actually incurred and paid. Couple of limitations around payroll. One, and this thing needs to be looked at on a individual employee by employee basis, but the salary rate or pay rate for any employee is capped at $100,000. So anything you pay to an employee in excess of that salary rate needs to be deducted from the or not included in the payroll costs. This only applies to employees who are U.S. residents. Don't need to be a citizen per se, but they do need to be resident. So you need to remove from your payroll costs any payments for employees that are not located in the United States, whether they're a citizen or not. And then independent contractors are not considered employees. And so any costs for an independent contractor under 1099, whatnot, needs to be excluded from your payroll cost calculations. So one of the things that can be noted is that the way you go about calculating forgiveness is different in a couple different respects from how you applied for the loan in the first place. I highlight three different things here. The payroll cost, forgiveness amount includes payroll, utilities, rent, and interest. It covers up to 24 weeks, whereas originally it was a 2.5 month calculation. And they have added these reductions for changes in FTE levels and reduced employee compensation to the calculation. So let's talk more about this FTE requirement. Basically, the law is encouraging people to maintain levels of employment. So to the extent that you've reduced your full-time equivalent employees between the covered period and the base period, your forgiveness amount is going to be proportionally reduced. So if employees are reduced by 30%, your forgiveness amount calculated will be likewise reduced by 30%. They are using a term or what called the FTE reduction quotient. That's the ratio of FTE during the covered period in comparison to that base reference period. And they're giving you three different alternatives for that base reference. And it needs to be the same period that you used in your original loan application. So it could be the February to June of 2019, January to February 29th of 2020. Or if you're a seasonal employer, you can pick any consecutive 12-week period from last year during the May to September 15th period of time. So if that FTE reduction quotient is greater than 1, then you've maintained headcount. There is no reduction in your forgiveness amount because of that. And if it's less than 1, then yes, your forgiveness amount will be reduced proportionally. And we'll show an example of that here in a minute. So the other aspects of this FTE requirement is that they have provided some safe harbors, as I refer to. If you do reduce employment, but then are able to rehire them back by the end of the covered period or the 12/31, you essentially don't need to comply or use that FTE reduction quotient. Other ways that you can adjust for that is if you did attempt to rehire employees, but they declined to come back, you can adjust that FTE quotient for that person as well. The important thing is you'll need to be able to document the offer and the decline. The new law has also expanded this safe harbor. So you can, if you can document and explain that you've had the inability to hire similarly qualified employees, you can qualify for this safe harbor and adjust that FTE number. If you can also show that you've been unable to bring your business back to the same level you were at in February, because of restrictions placed on businesses in order to comply with the COVID-19 pandemic guidelines and requirements. And there's more specifics around that in the actual SBA application, and we'll talk about that later. So the second area of reduction has to do with changing people's pay rates. So if you have an employee who's making less than $100,000 a year and you, for whatever reason, reduce their hourly pay rate or reduce their salary, those reductions could impact the amount of your forgiveness. In particular, they've established a threshold of 25%. So if you reduce the pay rate that the employee had during the first quarter of 2020 and reduce it by more than 25%, you'll have that extra amount calculated, and that would be a reduction of your forgiveness. Now, the safe harbor in this regard is that if you return the person's pay rate back to its February level by the end of by the end of the year, by December 31st, then you can avoid this reduction in your forgiveness because of having reduced people's pay rates by more than 25%. So I want to talk a little bit about sole proprietors because they are treated differently as part of the forgiveness calculation. In particular, sole proprietors that do not have any other employees. Because there is not any payroll per se for a sole proprietor in that situation, instead of you looking at payroll costs as a substitute for that, they're using the net profit from Schedule C from 2019 and calculating that on a prorated basis over the covered period up to 2.5 months of compensation. And that is further capped by a dollar amount of $20,833. So sole proprietors have an ability to have a portion of their loan forgiven for essentially a substitute of payroll cost. Now, when you consider the other payroll costs that are potentially included, such as benefits, retirement, et cetera, because the sole proprietor doesn't have employees, there would not be any of those other payroll costs. Now, the utilities, rent, and interest expenses can be included in the forgiveness calculation for a sole proprietor, but here again, it's limited to not more than 40% of the loan of forgiveness amount, similar to how those other non-payroll costs are handled for other businesses. So I mentioned earlier that it's going to be pretty We think fairly easy for many borrowers to have all of their PPP loan forgiven, but there may be instances where that is not the case. And so any remaining balance is up to 5-year payback, or at least 5-year payback. The interest rate continues to be 1%. One thing I'd like to point out is that interest on your PPP loan has begun accruing from the date of disbursement. Even though payments aren't required, you are accumulating interest cost or interest expense. Fortunately, the portion of that that's associated with your loan that's forgiven will also be forgiven, but any interest that's accrued on unforgiven balances will be owed and repaid over the period of that 5-year period of time. As I mentioned earlier, you're not required to make any payments on your PPP loan. However, those payments will begin as soon as you receive the forgiveness amount on the loan. And or if you don't apply for forgiveness, or those payments will be begin at 10 months after the end of your covered period. And for those of you who, as I mentioned earlier, have signed a note that's 2 years, you can have that note extended or modified with the agreement of your lender. All right, let's move into some hypothetical examples. So this is on a situation where we've crafted to illustrate a couple of the key aspects of this forgiveness calculation. Let's assume that you have a business with 4 employees who are U.S. residents. 3 of those employees make $52,000 a year. 1 of those employees makes a salary of $156,000 per year. The benefit cost for those 4 employees amounts to $1,500 per week. And in this particular situation, the business received their PPP loan on April 1st, which means that their original 8-week covered period ended on May 27th. And let's, for this example, assume that the borrower elected to keep their original 8-week covered period, which they're allowed to do under the new legislation, rather than choose a 24-week covered period or longer covered period than 8 weeks. So in this example, they had 8 weeks of salary amounting to $48,000. Because one of the employees made more than $100,000, we need to take back out the excess. So that employee had $56,000 more than the $100,000 limit. Divide 56 by 52 weeks, multiply it by 8 weeks, you come up with $8,615 that needs to be backed out of the payroll amount for the 4 employees. So that leaves $39,385 of eligible compensation. Now we add to that the 8 weeks of benefit costs, which amounts to $12,000, the $1,500 per week times 8. Total payroll costs for forgiveness purposes amounts to therefore $51,385. Now here's where the 60-40 limitation comes in. Because of that amount of forgiveness for payroll costs, a maximum of $34,256 can be incurred or claimed as part of forgiveness for the non-payroll costs of utilities, rent, and interest expense. So when you add those two together, the calculated forgiveness amount could be $85,641. In this particular situation, and for all these examples, the original PPP loan amount was only $68,513, basically taking their payroll costs for those making up to $100,000 and adding in benefit costs, multiplying that by 2.5 months. And the calculation is illustrated there on the bottom. So here's an example where a business was able to accumulate enough payroll and non-payroll costs during the course of the original 8-week period of time that was a covered period and accumulate enough of those costs to more than cover 100% forgiveness of their PPP loan. As a second example, let's take the same situation, but instead of the business being able to continue operating, they actually were in a difficult situation. They received their PPP loan on April 3rd, but they were not actually able to open back up for business until July 6th. They had to lay off their employees during the interim period of time, but on July 6th, they're able to open up business, bring the 4 employees back onto payroll, and continue on. And so they would elect a 24-week covered period. 24 weeks from when they received their loan on April 3rd brings them to September 18th. So in this situation, they only had actually 11 weeks of payroll salary for the 4 employees from the July 6th period of time to the September 18th. Again, they still had that one employee who was making more than 100,000. We now need to take back out of the payroll the 11 weeks of their excess salary of over the 100,000. So that calculates to $11,846. So their eligible compensation is $54,154. They had benefit costs during that covered period of $16,500, bringing total payroll costs eligible for forgiveness to $70,654. That 60-40 ratio applies again, and they can have a maximum of $47,103 of non-payroll costs. So their calculated forgiveness amount is $117,757. Again, in this instance, they have more than enough accumulated costs during that covered period to more than cover forgiveness of their entire PPP loan amount. I think this example illustrates the value of extending that covered period to 24 weeks. Had this not been the case, their original 8-week covered period would have expired before they even were able to open back up for business. And in that instance, they would have accumulated no costs that would have been eligible for forgiveness. So this example, compared to the first, illustrates the real value of that Flexibility Act, I think. So let's do a different example here. Same business essentially that we had before, 4 employees, but in this case, for simplicity, none of the employees make more than 100,000. 3 of them make 52, 1 makes 100. This is an example where tried to come up with a dire situation where the business would not actually have all of their PPP loan forgiven. So business was in difficulty for a variety of reasons. They had to let 2 of their employees go, and they further asked the 2 remaining employees to take a pay cut of 30%. And so in this instance, payroll costs are reduced. Benefit costs are also reduced to $750 per week. And but we have a 24-week covered period starting on June 1st, going to November 16th. So if we look at the calculations, 24 weeks of salary for only 2 employees at that reduced rate is $49,108. They had benefit costs of $18,000 during that period of time. Comes to $67,108 of payroll costs. That 60-40 ratio applies, and we have total forgiveness of $111,846. Now at that point you think, well, that's certainly a large amount compared to their PPP loan, but because of their changes to FTE and pay rates, there are some of the reductions start to come into play. So in this instance, they reduced salary by more than that 25% threshold. So that extra amount of salary forgiven or forgone of 30% minus 25%, so that extra 5% of salary needs to be calculated for each of the employees, and that accumulates to $3,508. So that's a deduction from the forgiveness amount. And then, they have to apply a FTE reduction quotient. Because they had 2 FTE in comparison to an original 4 FTE during the base period, that reduction quotient is 0.5. Multiplying that 0.5 times the $108,338 of a preliminary amount leads you to a calculated forgiveness amount of only $54,169, less than their original PPP loan amount. So there would be a portion of their loan that is not forgiven and is repaid. In this situation, you would think that the business would make the case that they are able to use that safe harbor in terms of justifying that they couldn't hire back the employees. But in this example, let's say that they're unable to do that or chose not to do the safe harbor calculation. Now, the last example we'd like to look at is the same situation we just talked about, dire situation, but in this case, they did not ask their employees to take a reduction in pay, and in fact kept the 2 employees that they retained at their full rates. So you have a total of $70,154 of salary over 24 weeks for those 2 employees. Benefit costs of 18 brings you to $88,184 of payroll costs. Applying that 60-40 ratio again, have non-payroll costs of $58,789 and a preliminary forgiveness amount of $146,973. You still have to apply that FTE reduction quotient. It's still 0.5 because they only have 2 employees. But the calculation ends up with $73,486, more than their original PPP loan amount. I think this illustrates part of the intent of the legislation is for businesses to keep their people employed and to not reduce their salary and compensation. So because they didn't reduce the pay rates for their employees and kept them at their original salaries, they accumulated more payroll costs, and therefore enough payroll costs to justify a larger forgiveness amount, an amount that would exceed their loan. All right, I pointed out earlier that there are definitely some requirements in the application and the program to document all of this. And so I'd like to review that quickly, and then we'll get to some questions. One, you're going to be asked to certify to a variety of things, primarily that your calculations, your amounts, the documentation that you've provided are true and are provided in good faith. You'll need to support the payroll amounts you're using with things such as tax filings, unemployment insurance filings to support the number of FTE, other documentation to support the payments that you made for health insurance, retirement, etc. And then for the non-payroll expenses, you'll need to provide documentation that verifies how much you spent, and also that those utilities and rent and interest were associated with loans or agreements or service agreements that were in existence as of February 15th. So you can imagine that you'll need to provide several different documents for that. In terms of forms and schedules, there's the forgiveness application with the certifications. There's a loan forgiveness calculation form and a Schedule A. And in future webinars, we'll provide more in-depth review of how to complete those forms. When it comes to payroll costs, I mentioned you'll have to do a lot of documentation for that. Some of the examples of those are bank account statements, third-party payroll service provider reports. We're hoping that many of the payroll providers will create special reports that do all of the PPP loan calculations for you as it relates to payroll, because you are being asked to look at each individual employee to determine their FTE and any changes to their pay rates. Tax forms, as I mentioned, are going to be part of that documentation, and potentially copies of receipts, canceled checks, etc., for things related to benefits. When it comes to verification of your FTEs, you have 3 different base periods to refer to. Here's some detail. One of the things that I want to point out is that we've provided a reasonable amount of detail in this webinar deck, and it's available for you to download a copy. So you'll have it as a reference as you go forward. And the other thing I'd like to point out is that there's a lot of documentation relative to payroll tax filings that you can use to evidence your FTE. So non-payroll costs, I mentioned a variety of those. I think the important things to note are copies of loans, agreements, or other things as of February 2020 to show that these obligations were in place at that time. And another key aspect of these non-payroll costs is that this is only associated with payments that are actually made during the covered period or at the first billing cycle after the end of that covered period. Sole proprietors, documentation here is going to be the Schedule C, and other than that, you're going to be required to have the same kind of documentation as the other borrowers for the rent and utilities and interest expense categories. One of the things that is noted in the legislation is that a variety of documentation must be retained for a total of 6 years. So any documentation that you have that is part of your calculations for Schedule A all needs to be retained for 6 years. Any documentation that was associated with your original loan application for the PPP loan needs to be retained for 6 years. This would support the possibility that a loan might be audited by the SBA at some point in the future. So we've covered a lot of information. I'd now like to open it up for questions.
Excellent. Thank you so much, Tim. That was great. I especially like the examples. So here are, we're going to start with some questions that came through, and the first one we received several times, and that is, when and how will businesses apply for forgiveness?
Well, there is no specific due date for a forgiveness application, so you can apply, at any time. I would suggest that what you do is you make sure that you've accumulated enough costs over the period of time, the covered period, to get the maximum amount of forgiveness that you're able to, and also that you've accumulated all the associated documentation so that when you submit your application, it is complete. So whenever you're ready with all of those things, you can go ahead and apply for forgiveness.
Excellent. Thank you so much, Tim. Okay, so we have a question here from Barbara. She wants to know, seasonal employers are coming into their off season. Will this impede forgiveness in any way? And there might be layoffs until the crop is ready to harvest.
That's a good question. There is some flexibility in the program in terms of choosing that base period for seasonal employers. So you can look back into last year's FTE levels to come up with an appropriate base that corresponds with your season. The extension of the covered period out to 24 weeks also can hopefully bridge you across a good portion of the seasonal of your seasonal pattern. Can't say that that's going to take care of every single seasonal business in terms of their situation, but those two things will certainly help.
Okay, great. We have a question from Debbie. She wants to know, is interest paid on credit cards covered?
Our understanding is that debts of the company are covered if they're secured by property. So unsure in terms of clear guidance yet from the SBA regarding credit cards. And so that's one of those examples, I think, where it would be nice to have a little bit more from the SBA, but at this point we're pretty confident that loans that are secured by either real estate or business personal property are covered.
Okay, perfect. Frank asks, if your company is eligible for either the 8-week or 24-week period, can you wait to the end of the 24-week period to make your decision on the duration of the covered period?
Yes, really the choice of covered period is up to you. You can elect the original 8-week period or go with the longer covered period. And since there is no particular deadline for applying, you could wait until the point in time where you actually apply to decide which period makes best sense for you.
Excellent. All right. Jasana, and I'm sorry if I butchered that, are workers' compensation insurance and unemployment insurance related taxes able to be included in the eligible payroll expenses counted in determining the loan forgiveness amount?
I'm sorry, but could you ask that question one more time? I just want to make sure I caught the different pieces of it.
Yes, absolutely. Are workers' compensation insurance and unemployment insurance and related taxes able to be included in the eligible payroll expenses? I think that's the main thrust of it.
Yeah. Actually, no. The current guidance would say that those are costs that are not cannot be included in the eligible payroll expenses. Costs for state and local payroll taxes can be included in the calculation, however.
Okay, that's great. I think that answers that question. All right, Jeffrey wants to know, are borrowers allowed to choose more than 8 weeks but less than 24 weeks for their covered period?
Good question, and it actually is kind of in keeping with this program. Guidance is a little fluid and continues to change. The application form that was published just this morning would indicate that you can have that calculation be through the point in time when you actually apply for forgiveness. So it may not be that you need to wait until the end of the whole 24-week covered period.
Okay, great. Melinda asks a similar question. Does the borrower need to request a change from 8 weeks to 24 weeks?
There's no need to actually request. It's simply a choice that you make at the time that you apply for forgiveness.
Okay, perfect. Jennifer wants to know, can I use 100% of the loan on payroll costs?
Yes, absolutely. If you accumulate enough payroll costs during that period of time, you can use all of that to justify your forgiveness amount.
Okay, very good. Ricky asks, if a borrower chooses the 24-week period, there seems to be a cap on owner's salary of $20,833. Is there a similar cap to non-owners?
The cap for non-owners is tied back to whether their salary rate is at $100,000 or more per year. So whatever period of time you're looking at for the payroll costs for employees, as I showed in the example, any amounts that you're paid an employee over an annualized rate of 100,000 needs to be subtracted out or not included in your payroll costs. So there is that limitation. That translates into a limitation of $15,385 for any employee during an 8-week covered period, and would translate into more than that. I haven't done the math in my head right now to cover for the 24-week period of time. But again, you adjust the average pay for an employee to make sure that you're not over the 100,000. But that applies to employees whether they're an owner or not.
Okay, great. Susan wants to know if bonuses can be paid.
Yes, bonuses can be paid. Still, again, subject to the limitation that no employee can be paid more than $100,000 annualized pay rate.
Okay, great. Adam wants to know, does paid parental leave during the covered period or alternative payroll covered period affect FTE requirements?
No, our understanding is that FTE is based on hours. Well, hold on a second. Let me rethink this one. Yeah, we
Take your
we
time.
think that an employee on paid leave is still considered an employee because you're paying them for essentially the equivalent of time that they would have been working. So they're paid and they can count towards the FTE requirements, whether they are actually working or on leave for a justified reason, obviously.
Okay, great. Karen wants to know, can I pay an employee that is on unemployment?
No, quick answer there. PPP loan funds for payroll really can't be used for people that are unemployed, because technically, if they're collecting unemployment, they are not employed by you. So either they're an employee getting paid, or they're not, and they're getting unemployment. So can't double dip in that regard, I guess.
Well, that makes perfect sense. John asks, are non-payroll expenditures limited to the covered period or alternative payroll covered period, or can they be accrued before the covered period?
Uh, the general answer is no, you cannot pay back pay during the covered period. The payroll costs have to have been incurred or during the covered period and paid either during the period or at the next payroll cycle.
Okay, great. We have a couple more questions. Joyce wants to know, when is the forgiveness application due?
Forgiveness application is no specific due date. However, you probably should wait till at least the 8-week covered period has ended. And again, I pointed out that the important thing is that you've accumulated all the appropriate documentation and hopefully as much payroll and non-payroll costs as you can before you apply.
Okay, perfect. Kyle asks, if a business has been forced to close due to shelter-in-place orders, are borrowers required to continue to pay employees even though they are unable to operate their business?
The Paycheck Protection Program doesn't really put any requirements on how a business chooses to operate its business. So you can pay employees or not pay employees in that situation depending on your own choices. What it does, however, do is talk about how can you get a portion of your PPP loan or all of it forgiven, and those are tied back to what you actually expend during the covered period on payroll and non-payroll. So if you pay your employees during that period of time, even though they can't actually work because of restrictions, you'll be accumulating payroll costs that could in fact be forgiven. So it's your choices as to how you best want to handle it. If you don't want to pay them during that period of time, then you really look to once you reopen business, can you accumulate enough payroll costs and other costs to eventually get your maximum amount of loan forgiveness, down the road after the end of the 24-week covered period.
Excellent. Well, Tim, that's all the time that we have for questions today. I would like to take this opportunity to thank you for the information. It was so great. And I
Okay.
want to thank our clients for putting their faith and trust in Farmers and Merchants Bank. You are what makes us California's strongest. Please reach out to your relationship manager with any questions, and then remember that we are also here to navigate you through this process. As I discussed earlier, stay tuned on our website for the questions submitted, the recording of the webinar, and the slides from the presentation. And we also hope that you'll join us for the next installment of the webinar series, which is coming up next Wednesday. Until then, have a fantastic day.